Today I will like to discuss with you marginal costing of your cost accountancy. Now what is marginal costing? Marginal costing means increase in the total unit of total production due to marginal increase in the units. That means, take for example, I am producing 10,000 units of a product and it has cost me rupees 1 lakh. Now again I need to produce 100 additional units. So this 100 additional unit, take for example, proportionately cost me 10,000 more. So then what will be my total cost? For total cost, this 11,000 units will cost me 1,10,000. Now similarly, this can be in decreasing order also. Take for example, earlier I have produced 10,000 units. Now I want to produce 9,000 units. So 1,000 units is been decreased. So similarly, my total cost will also get decreased. So marginal costing in accountancy means when there is a variation in the cost of production and total cost due to increase and decrease in units of production. Now, what is the accounting formula? There are basically three aspects in marginal costing. Number one, total sales. Number two, variable cost. And number three, fixed cost. Now, sales, we know what is sales, my output. Variable cost. Variable cost means the cost which varies with the unit of production. That can be exampled as your material and your labor. The more you want to produce, the more material you wanted. The less you want to produce, the less material or labor you wanted. Next, your fixed cost. Fixed cost is the cost that is irrelevant in the units of production. Whether you produce 1,000 units, it will be same. Whether you produce 1 lakh unit, it will be same. So fixed cost, example, your building, your machinery. Now, what is the formula then? The formula is sales minus variable cost will give you the term called contribution. Then after getting the contribution, we will deduct the fixed cost from contribution and we will get the profit. So the formula, again I am repeating, sales minus variable cost will give you contribution and contribution minus fixed cost will give you the profit. Now variable cost, as the term implies, it varies with cost of production. Now the question arises, why does a company in cost accountancy do marginal costing? See, marginal costing is very essential when there is a fluctuation in your production. Mostly the seasonal goods are very much beneficial with this type of product costing. Example, the ice creams, the cold drinks, the soft drinks in the summer season, the raincoats, umbrellas factory in the rainy season, the winter cloth factories in the winter season. Their cost, their profit will vary to very some extent due to this variable cost. I hope this small basic idea will give you some rough idea of this marginal costing. Now, what type of question you can expect from this? Basically, this is totally a practical chapter. Questions you need to solve from your books. But if you go for theoretical part, what is marginal costing? What are its characteristics? What is the techniques? How profit is determined under marginal costing? What is sales, fixed cost, variable cost? With example, how does it increase and decrease? So, please go through it. Thank you. Be good. Stay at home.